So this morning we have economic news out here in about 8 minutes or so. Here's the daily chart on micro NQ, and if you notice that we have went up in here, took out that high. Now I stated that I'm bearish. I want to see lower prices, and we were down in here. I said it could come up, fill in this little inefficiency here, which it did. Spent a lot of time in there. Then we had this candlestick right here. I taught lecture on stating that the body was not able to go below the previous day's body, and this body was not able to go above previous day's body. So this is an inside day, despite the fact that it went higher on the wick. Okay. So, long story short, I said that this might happen. It might bump up in there, and it may challenge my stance. But it went up here and bumped that high. You can see it hit it here, and that now has been taken. We revisited that volume imbalance and took the liquidity. And now look at this. Does this bode well for bullishness? I would argue against it. Now we have PPI this morning. So in a couple minutes, about 5 minutes from now, there's going to be a lot of volatility that's going to come into the marketplace. And I think that it may want to seek the sell side below that short-term low right here, because we've already came up here rather aggressively, hit it, and then it said, no, I'm not interested in staying up there. And then it respected the volume imbalance again here, opened and went straight down. We have a volume imbalance here. So worst case scenario, let's say that at PPI, the market does a wild spike, does some crazy business, and it could revisit this and then go lower, or just go straight lower. Either way, my primary interest is lower. We have a larger sell side liquidity pool here. So with that idea in mind, let's hurry up and quickly drop a. So we have this logic here, and we have yesterday's low, which I guess we can highlight that as well. And then we'll drop down to 1 minute chart. If you look at the 1 minute chart here, this red box up here on the daily chart, it's that volume imbalance. So let's go back out to a daily chart real quick. So there's our key levels for today. We already pierced yesterday or previous day's low there. And here's that volume imbalance. All right. So back down into a 1 minute chart. The daily volume imbalance is up there. Okay. So now let's go over to last night in the London session. Now let's go through and look at time. Here's 2 o'clock in the morning to 5 a.m. London open kill zone. That's what that is. In this setup, you're going to see using a higher time frame premise, which is this pink box, which is what? It's the daily volume imbalance. So here is that area through the lens of the ICT London open kill zone. So the market travels outside of it. It does so here, creates a run there, and then drops down into this inefficiency. This right here could be used for a model 2022. You could be entered into that, and you could have been stopped out, and you could take a loss. And let's just, for the sake of conversation, let's just say that's what took place. Okay, I want to be practical. I want to be able to tell you things that you're going to encounter and how to work with it. Okay, so let's assume that you took this trade and you got stopped out with a stop loss rate above this high, or maybe you gave it some extra room and you used that high and you got stopped out right there. So the market creates another run higher than that. Are we bullish based on what we just saw happen in NASDAQ in the last 2 days? You shouldn't be, because it went up to a pool of liquidity, tapped it, and then failed to hold that level after NVIDIA earnings. NVIDIA many times will push the market from a fundamental reason, but if that's the fundamental reason, what is it really doing? It's propping up the market so that way retail traders that see that say, oh, wow, this one stock's going to make all the entire stock market go up for the next couple weeks. That's a fallacy. It means it's a myth, okay? So we have a hypothetical stop out on this run here. If this is in fact the high of the day or a turtle soup, the market needs to not only displace lower, but it needs to get into a level from a higher time frame perspective, which is that volume imbalance on the daily chart that's showed here in red. Here, we see it dive down in. There's a small little gap. You see that? So this inefficiency, because this SIBI right here is not butt up against this wick. Now, if this SIBI was this immediate candle to the right of this wick, we wouldn't be using the fair value gap. We would just be measuring the wick. This wick right here, if this was exactly to the immediate left of the SIBI, but see, we have the SIBI formed here where there's one candlestick barrier to that wick. If this SIBI existed right up against this as the immediate next candle to the right of that one, we would not use that fair value gap at all. We would just simply use the gradient levels on the wick. This SIBI, because we don't have the wick to the immediate left, this is a valid premium PD array. So it would be viewed like this. So right away you can see we used the top of the volume imbalance. We traded back into the gap and it went one tick above, just coloring outside the lines of that volume imbalance on the daily chart. If you were shorting this, any short entry in here, the stop needs to go right above this candlestick's high. This is where your stop loss would be, and your entry would be anywhere in here. Now, which price level would you use? Well, think about the logic. Okay, we're talking about high probability entries, but now we're going to incorporate lower time frames, sub 1 minute. So now we can go into this little range right here. The stop has to be defined right there on that high. Why? Because of the volatility. Now, because of the volatility being so extrapolated and large, we have to consider the formation of the setup time frame for our stop loss. Whereas if we didn't have this wild volatility, then we can go into sub 1 minute in this fair value gap that's shaded here, that's darker. We could use that, and the stop loss could be framed on this swing high in here. And I'll show you what I mean. Let's drop down into 30-second real quick. And that's the business there. You already noticed on the 1 minute chart that the bodies were already staying in the lower half of that fair value gap. So what you want to see is how the market trades into the upper half. You give it a chance to do so. You might miss the trade. It might happen where it goes up there so quick and then starts running away. Well, you missed it. But because you're in the lower time frame setups, there's so many of these forming. So you want to try to enter in the lower half. That's your high frequency trading window of entry. The barrier of entry is you need to be inside of this portion of the move. And I know some of you don't like the idea that you want to get up here in the upper half. Sure, I do it sometimes, but my experience is a little bit larger and longer than yours. So how do you get in the move and know that you're going to be a part of it and not be afraid that you're going to miss the move? So you want consistency, continuity, but you're also not going to over leverage and over trade. You don't care if you get stopped out. In fact, we're going under the premise that you got stopped out overnight in the London session. Now you're using it again. Notice that we're using the high of the volume imbalance on the daily chart because it's a higher time frame PD array. It trades to the high of it. And does it hold that candlestick? Because it opened here and went all the way up here. At one point, there was a big green candle like that. And then it does this, comes down here and closes. Where does it close? Below consequent encroachment. That's this level right here. So now the immediate next candle, anywhere below that midpoint, that consequent encroachment, anywhere in there, but above the low of the candlestick's high, which is the framework of the low of this gap framed on a 1 minute chart. You can enter here. If we were not seeing elevated volatility, you could place the stop loss one tick above this high. But because, listen, folks, listen, man, because the volatility is so extreme, because the likelihood of the ranges sharing the previous candle's range, you have to go outside of the immediate smaller time frame price range, which is what we're identifying here. So you got to go back to that 1 minute chart and use the high I showed you. You can't try to trade with these super tight stop losses and not expect to get stopped out a lot. You're going to get stopped out a lot. So you want to enter in the lower half, use the higher time frame where the setup formed, use that for your stop loss. That means, yes, you're probably going to trade with less contracts. And that's a good thing right now. So the market uses this area for entry, and the immediate run would be here. Me personally, I would like to see a minimum of 15 handles. So as luck would have it, you have something over here. So now we're closer to that 15 handle run. So getting short up here, aiming for that pool of liquidity right there as a first primary scaling opportunity to take a partial. There's sell side. Entering on a premium. Premium to what? That sell side liquidity pool. And then we have that low. Now, this low is more likely to be a factor because what? What's this dotted line here? That's consequent encroachment of that volume imbalance on the daily chart while being bearish because it rejected the recent highs on the daily chart after NVIDIA earnings. So consequent encroachment is always a draw. Always a draw. It's always a draw. And if we're up here, first partial, doesn't mean you have to take it, but it means that once we get below it, then we want to see displacement. If you're not going to take a partial and you're only trading with one contract, wait for displacement. What does that look like? That. We could create a short-term low, then it dives lower, closes, the next candle starts to run lower. You can see that is displacement. So now you can, instead of taking a partial here, you have one contract, roll your stop loss from where it started over here down to just above that high. So what I just taught you was how if you're only using one contract and you can't take a partial, because if you take a partial, you're closing the only existing position size you have. So you wait for a key low, which is what I just mapped out here. Not this one, because I want at least 15 handles or I won't take the trade. Once it takes that low out where a partial would be taken, that displacement affords me the opportunity to then move my stop loss just above that high. What high? This candlestick, because this is the displacement candle. And then as it moves lower and lower and lower, we want to see it gravitate to consequent encroachment, which is that big red area from the daily chart. That's that volume imbalance. That's the draw. When it does that, okay, we anticipate it not just trading here, but there's liquidity resting below that. That's the sell side liquidity pool that you could take a partial or a full closure or wait for it to use that level and displace away from it. Where is that? There. It trades above it here a little bit. Your stop loss, if you were trailing it and you only had one contract, would be here. You're not in jeopardy. You're anticipating this. The market rolls through. Once it leaves this key level on the downside again, you're looking for displacement. Is this displacement? No, it's not displacement because it created this low right there. That low needs to be pierced to the downside. Does it do so? Yes. Does it do so and leave it as a SIBI? Yes, it does. So when it does this, then you can move your stop loss from here down to this candlestick's high because that's the leg that starts the price run lower. This run is sell side delivery, not sell side liquidity. It's the running lower of price action. So that means you put your stop loss right here. So now what you have done is you've captured very close proximity to that low where you would have closed your trade for full target. Remember, you're on a very small time frame and you're using a micro structure approach to trading these price legs. Once this does this, you've afforded getting stopped out, holding the position in case it gives you a little bit more room to run to where? The low of the volume imbalance. Why? Because we're bearish. This little gap in here gets traded up into here and then runs to the low. That would be your next objective. So you can close it there and anticipate some measure of retracement. Why? Because this is a higher time frame daily volume imbalance. It may come back up to consequent encroachment of it. But if we're bearish, we want to see it not do so. Here's where it trades up to here and then rolls over and goes lower. But I wouldn't have caught that. Stop being fucking greedy. So, Michael, please stop cussing. We're talking about trading. Okay, it's going to come out sometimes. So if you are looking for a larger price run, you can see anticipate it retracing back to consequent encroachment. But then if it displaces outside of and below this low, because the displacement has to go before below a key low or above a key high. Is this displacement here? Yes. The market trades back up to the low of the volume imbalance on the daily chart, that big red box, and then it moves lower. Once it displaces below that low here and it closes, you can move the stop loss from here down to that candlestick's high. And the market trades lower and eventually dives even lower and moves into those targets I gave you this morning where it was gravitating towards an old, smooth little area. Okay, we're getting close proximity of those same time frames. Now, I wasn't on the chart at 5 o'clock in the morning with you all, but you can see how that would be useful here. And once we had displacement below this low leg, that you could trail your stop loss from there down to that candlestick's high. And then you're strangling the position because it's already moved so far outside of the level you anticipated.